All right, welcome guys, welcome. All right, ooh, 7 likes. Thank you guys, thank you. Just make sure that everyone in the private CFO Discord and my readers of the CFO Stream Watch report are also notified here. But before I do that, let me make sure my audio is doing okay. Okay, I think we're good. Okay, well, okay. All right, let's lower that music down. Okay, so as you guys see in the title and in the description box down below, which I always highly recommend you guys to read first before you just decide to jump in the stream, right? Just take notice of the title and the description box and read it. So tonight we're going to be talking about whether or not this move down is going to give us a good dip buy opportunity. Now, I've already went over this with my CFO Stream Watch readers, the report readers, and the private members of the private CFO Discord. So if you guys want to become a member and a reader, make sure you guys DM me on Instagram at ChartsFocus1 or take a look at the link down below. Okay, so the link that you guys want to take a look at is the CFO Stream Watch report link. I mean, you guys can see it down there. It's not really a thing that I need to explain to you guys. But once you do become a report reader, you'll automatically gain access to the CFO Discord community. Okay, so make sure you guys check out the link down below. And if you guys want to get a 50% off discount code for your first 30 days, just DM me on Insta. That's all you have to do. But if you want to pass on that opportunity and just become a member right away, just click on the link in the description box down below. You guys could find it. I mean, you guys should find it. It's right there. I just have to scroll a little bit down or you know, just look for it, basically. All right. Okay, so with that in mind, let's take a look at what's going on with the market. So first of all, yesterday, right, Jerome Powell, we obviously knew that the markets were going to well, the Federal Reserve is going to cut rates by 25 basis points. The markets have been pricing in that for a long time. And even back in the first rate cut back in September, which was a 50 basis point rate cut, we also got hints that they had a total of 50 more basis points of cuts, worth of cuts on the table into the end of the year. And this is when I told everyone, including you guys in public and for all my private readers and members, that it seems like with this total of 50 basis point worth of rate cuts, they're most likely going to be doing a 25 and a 25 basis point rate cut for November and December's FOMC meeting. And so voila, here we are, we got that. Okay, so now you know, people are asking me as well, you know, how did you know that? Well, I mean, it's just something that you know when you continue to read what the FOMC meetings give out, all the content that they give you now, the Federal Reserve FOMC minutes that they give out too, which I highly recommend everyone to read. And so, you know, it's not rocket science, right? It's pretty much a black and white deal where you can't understand what they're doing with the current rate cut cycle. But now, here's where things are getting a little bit shaky. All right, so let's go over what happened yesterday in the Jerome Powell news conference. So what occurred last what was it? Well, it was lunchtime for me, but for all the people in the East Coast, it was already a late afternoon or near late afternoon or mid-afternoon. So Jerome Powell basically hinted at the fact that the Federal Reserve is still going through things data by data, right? They're going to be doing and taking action on their monetary policies and rate cuts data by data, month over month, week over week, right? Whatever economic data is pertinent to their current actions considering the current rate cycle, rate cut cycle that they're in. And so, you know, it seems like with this continued rate cut, they're being a little bit more cautious now because, as I've already told my members before a couple months ago, inflation is starting to become a little bit sticky, right? So core inflation and headline inflation has definitely gone down, but as Jerome Powell himself stated yesterday, it hasn't gone down as quickly as they have wanted it, right? Or as they've expected it to with their current actions, including rate hikes. Now, what does this mean, right? People have been focusing on that statement so much the past couple of hours since yesterday that I think they're looking at this from a wrong perspective. Okay, so instead of focusing on the fact that the Federal Reserve has quote unquote, you know, basically stated that, hey, we're not seeing the rate of inflation coming back down as quickly as we expected, right? Don't think of it as if like they're saying it as in what's the correct word here? Like as if they're defeated, right? So a lot of people were thinking that that statement was saying that, hey, the Federal Reserve is defeated, right? They can't do anything about inflation anymore, okay? And so that's something that I think it's an erroneous way of thinking for how the Federal Reserve is taking this current economic and inflation reports that we've been getting so far, including the labor market. And so the way that I would take a look, well, we should be focusing on what the Federal Reserve is going to do in the near-term future, right? In the next fiscal year's FOMC meetings, especially for quarter one. So we have a January FOMC meeting coming up, and oh, did we lose connection here? Okay, no, we're back. I think we're back. Hopefully, it didn't cut off anything that I was saying here. Is everything okay, guys? Just give me some reactions here to let me know that everything's fine. Let's see. I think my playback is fine too, so we should be good. Okay, I think we're good. We are good. All right, so hey, I see you guys' reactions there. Okay, so with with Jerome Powell, you know, and him and the Federal Reserve basically saying this, to me, it just hints that they're still a little bit in a comfortable spot. Now, believe it or not, right? Believe it or not, this is what I think. Okay, and I mean, I also knew this as well. Well, I'm getting a feeling of this because yesterday Jerome Powell was also not too stressed looking. And you can tell when he is stressed during his news conference if you have been watching him for the past couple of years. And so it seems like the Federal Reserve is still very much just laid back, comfortable with where they're at right now with the benchmark interest rate or the federal funds rate, the target range specifically, and with the current plan for rate cuts into next year and all the way up into 2026. Now, okay, again, I think most people like on FinTwit or people who are just amateurs and looking at what the Federal Reserve is saying and what Jerome Powell said yesterday, they think that they're emitting, quote unquote emitting. That's the correct word that I was trying to think about earlier and say. They think that they're trying to admit that they're wrong with this rate cut cycle, or maybe they should have hiked rates higher than what we've had so far, right? So I don't think it's any of that. Okay, and so for me, the reason why the markets have reacted to the downside so much is that the Federal Reserve is just expecting to go through this data by data, which is what they've been doing so far, and the markets aren't liking that. But again, let me give you guys a full rundown of what has occurred this entire year. Okay, so the S&P 500, well, since last year has doubled. Again, it has doubled, right? Since the 2022 bottom, well, yeah, it has doubled since the 2022 bottom, right? And, well, that's 2 years ago, my apologies. And so we've been front running all the way up into the very first rate cut that we were gonna get, eventually gonna get in this year, right? And if you guys remember back in 2023 as well, somewhere in August, mid to late August, I also gave you guys my own prediction of when the Federal Reserve was going to cut rates. And I gave you guys either right before the turn of Q3 of 2024 or during 2024. And guess what? We got our first rate cut in, during Q3 of this year. So that prediction came true, and again, that prediction came last year in August, mid to late August. Now, I don't have yet a prediction yet for you guys for any type of future rate cuts, but what we should all understand and know is that the Federal Reserve is looking at 2 rate cuts for next year. Now, I would say it's a range of 2 to 3 rate cuts next year. Okay. Now, I do not think they're gonna do rate cuts next in the next FOMC meeting, which is again next month for the new fiscal year of 2025, and that is what the markets are reacting on. Right? They're reacting on the fact that the Federal Reserve is quote unquote emitting, and again, I think that's erroneous thinking here. But this is just pure emotions and overreaction. But the markets have reacted to that, saying that, oh my God, the Federal Reserve is not going to do well next year, because if inflation goes back up, what are they going to do, right? Because we've only cut 3 times. Okay, we've only cut a total of 1.00 basis points, right, or 100 basis points. Okay, and the interest rates, or the federal funds rate, is still pretty much at highs, right? So what else can they do, right, other than maybe potentially wait for an economic recession, right? But no, they don't want that. We've been seeing an orchestration by the Federal Reserve to create a soft landing, and that's exactly what we got so far. Why? And if you guys don't believe that, well, just take a look at the economic data. Right? The economy has been moving and growing and expanding very, very well ever since I believe 2022. Right, so we had that brief hiatus in the overall market growth from the peak of 2021 after that huge surge in economic output and productivity from the lows of 2020 to 2021, when I'm referencing to the market, and around mid 2021 to all the way down to the bear market of 2022. So like late 2022, we saw the overall economic growth and output and expansion slowly die down. Now, for the last 2 years, 2023, including this year, we've been seeing the market absolutely continuously roaring back to the upside. We're seeing some amazing data that continues to point towards economic growth and economic expansion. Now, okay, if you guys remember, a couple months ago, I told you guys that the economy is most likely in the cool down mode, as we're starting to see the labor market finally loosening up, which is the goal for the Federal Reserve. Okay, and I kind of want to go back to that dual mandate before I move on here. I kind of want to go off on a tangent here, right? So I've told my members this a couple of times throughout different CFO Swing and Watch reports, a couple of, I think, throughout the second quarter and third quarter, okay, whatever it was, okay. I've told everyone that this dual mandate, right, of getting prices down and loosening the very tight labor market has been done absolutely well by the Federal Reserve, right? We've known this, right? This is actual data that we can see and verify. I'm not just pulling statements out of my butt here, right? And here's the thing. All right, so when we're concerned about the labor market seeing continued unemployment claims rising higher, so the trend is still going higher, it's not plateauing anymore, it's still climbing up higher slowly, ever so slowly, and along with the fact that the unemployment rate has gone up as well, over 4%. I think it's like 4.1 or 4.2% right now. Again, I apologize if I'm wrong about that. I have a lot of data in my head. So I do not have the most updated data right now in my head, but that's fine. So what I'm trying to get at here is that people were saying that the Federal Reserve back in 2022 that we should just cause a recession, right? The Federal Reserve should just induce a recession and completely break the labor market, right? Where we have a skyrocket of unemployment rate and unclaimed unemployment claims. And of course, that was not something that they wanted. Obviously, that would be very, very bad for the overall economy, as it was just coming out of a recession from COVID. Okay, and it just didn't make sense to do that, obviously, right? And so now people who are looking at the labor market and saying that, oh my god, these unemployment claims are going up and the unemployment rate percentage continues to climb up higher, okay, is something that we should be worrying about all of a sudden, right? This is the same group of people that were saying that, hey, and when I say people, analysts and just people, like retail traders and FinTwit, and it was just the overall majority of people were saying, oh my god, this is bad, the Federal Reserve messed up, right? But they completely forget what the original mandate was on their dual mandate for the labor market. It was to loosen up the labor market, which means we need to see unemployment rates slightly going back up and unemployment claims continuously rising as well. So this is still something that is currently occurring, and this is what they wanted. So to me, right, it doesn't make sense that people are trying to say the complete opposite now. And the markets are even reacting the same way too, right? That the majority are saying, oh my god, the Federal Reserve has completely screwed up now. Because, hey, White Horse Farms, I will be telling you that soon. But hey, welcome guys, there's a lot of people here tonight as well. Welcome guys, welcome. I see a lot of new subscribers too. But make sure you guys hit that like button down below if you guys are understanding what I'm saying here and if you guys are enjoying what I'm saying here. And most importantly, by the end of the stream, if this stream was useful or even applicable, maybe tomorrow or for the rest of this month, make sure you guys come back to the channel and hit that subscribe button. If you guys don't, that's fine. That's on you. Okay. Hey, Hugo, what's up, man? So, back to what I was saying. So that was my slight tangent there. The Federal Reserve is comfortable because they have made these current conditions of the labor market loosening up and inflation in a downtrend. Okay, they're comfortable with this condition. Now, as we head into the next fiscal year and into the next set of inflation and economic reports, okay, I personally think that the markets have already overreacted way too much, right? Even with yesterday's move and including today's move as well. Now, here's the thing, right? The reason why I think that the markets have overreacted is that, well, first of all, the Federal Reserve is still going by data, right? Month over month, week over week. Okay, and they're still going to be making actions and monetary policy actions based on these data points. And so right now, this is clearly an overreaction full of emotions that the Federal Reserve has screwed up, quote unquote screwed up, which I don't think they have screwed up, because how could they have screwed up if inflation is still at the same prices or same percentages as we've seen last month and even the previous 2 months ago? So, to me, this is very short-term thinking that's currently affecting the markets and currently hurting the markets as well, right? So obviously, technically, I have a different opinion, but I'll let you guys in on that soon. But I want to finish this off by saying, think in a more longer-term manner, guys, right? Because the Federal Reserve didn't quote-unquote admit anything, that they're completely screwed over, that they can't do anything about inflation. Yes, they may have revised their inflation target to 2.5%, and or there's a possibility of them revising their inflation target to 2.5% or even higher. But again, they're doing this data by data, right? We're still in a rate cut cycle. I have yet to see or hear from the Federal Reserve itself, or maybe I might hear it in or read it in their next FOMC minutes report. Who knows? But we have yet to hear anything from them that they're considering to have rate hikes back on the table. And this is what's kind of getting me riled up here, because they haven't said anything about rate hikes, right? We're still in a rate cut cycle. They have stated in September and November that they're still stern on cutting interest rates because we're at historical highs. And so, again, guys, keep a level head, right? I see a lot of people on FinTwit, on different social media websites, on different forums online about talking about the Federal Reserve and stock market. They're all going crazy. They're all popping their heads off saying, oh my god, we're gonna have hyperinflation, we're gonna have stagflation. They're just putting out words out there, right? Saying that the Federal Reserve has completely screwed us, the economy is in trouble. But that is not the case, right? The Federal Reserve is still in a very comfortable position. Yes, could they get overconfident while they're sitting in this comfortable position? Of course, right? I'm not disregarding that at all. All I'm saying is that try to be calm and collected and focus on the longer term perspective, right? Nothing has happened yet. We haven't seen inflation rise like crazy. We're not seeing the supply and demand or supply chains going absolutely bonkers again, like we saw in the COVID pandemic, right? We're not seeing the similar situations as we saw back in 2020 or even just 2022, right? When we saw a nice market correction that led into a bear market. So we're not seeing any of those conditions yet, right? But once again, the markets have reacted on the short-term overreaction emotions that have been brought on by the fact that people are worried that the Federal Reserve has screwed up. But again, my personal opinion now. Okay, so let's end this on a positive note. I do not think that the Federal Reserve has screwed up at all because we're still going by data. Yes, the services part of inflation, right? Because we have goods and services. Goods inflation has gone down a lot. Services inflation has continued to be sticky. And this is where the services inflation can be at the current levels for quite some time before we see another move down. But we need to understand, or you guys need to understand as well, that when we see overall economic expansion, okay, we also see an increase in demand, right? We've been seeing this. We've been seeing consumer strength, right? The overall average consumer has been continuously spending, and we're still seeing some good consumer sentiment, even though people have been increasingly worried about the continued rise in prices of certain goods and most services. But we continue to spend, right? Because the economy has been growing. However, this is basic economics, okay? Basic economics here that I want to give you guys. It's basic economics 101, right? So whenever we see the economy surging, right? We're seeing the economy, overall economy expanding, right? Demand will also go up as well. You guys understand that, right? Does anyone understand? I just want to see some reactions in the chat just to make sure that I don't lose you guys here. Yes? Okay, hopefully you guys understand. Right, okay, I see you guys some reactions there. Okay, so okay, this is just basic economics 101. When the overall economy expands, and it continues to expand in a good pace, we see demand also rising up as well in tandem, obviously. But when demand goes up, sometimes supply can become low, right? And that will force consumers, us, to pay more, right? Because we're willing to pay more as well on top of that. And we've been seeing this. Consumers continue to spend. We're seeing consumer debt rising as well. The credit card debt continues to rise as well. And that results in inflation, right? So the economic growth can also cause inflation on the certain conditions that we are in. And so that is what I believe that the Federal Reserve is worried about next year. Yes, we also have the potential Trump tariffs coming into play that can also affect the affected products that are imported to the U.S. And obviously those tariffs will be passed down to the consumer. And if you guys disagree with me, well, you guys probably didn't take economics 101 or just basic economics class in high school or even in college, but that is how tariffs work. Okay, it has nothing to do with politics, but that's exactly how it works. Okay, it gets passed down to the consumer. And we saw this in 2018 to 2019 during Trump's tariff war with China. If you take a look at the exact items and supplies and whatever it was that was imposed on with tariffs, all of those goods or supplies, they all rose in price. Okay, that is the truth. Just take a look at the data from 2018 to 2019 and see what goods and supplies were impacted by the tariffs, and you see that the prices went up, and that was passed down to the consumers. Okay, so yes, there's that aspect to worry about, but just from an economic perspective, right? Just from an economic perspective, we are seeing potential for this economic surge or economic expansion to cause more inflation. And I think, personally for me, we're already seeing that with services inflation being very, very sticky, right? And so with services inflation being sticky, okay, that's probably pointing towards the fact that this economic demand and expansion can cause inflation to slowly tick back up higher. But again, the markets tend to be very, very sensitive and hypersensitive if we do see a reversal trend back to the upside in inflation. And that is the reason why I think the Federal Reserve is trying to hint at the fact that they might have more pauses on the table compared to rate hikes. Once again, I don't know why you would be even thinking about rate hikes or anyone else, because they haven't really said anything about that at all. So again, do not think about rate hikes. They have not said anything about that. They haven't even stated that that is on the table. They've only stated that we'll have pauses. Okay, well, not directly, but they've hinted at that, and they've hinted at the fact that that pauses are on the table based on the dot plot, the infamous dot plot that everyone tends to look at. I think it's overrated. That dot plot is very overrated, because I think what the Federal Reserve does depends more on what the overall economy looks like and all the inflation reports that we get every single month, right, or every single week with the labor market as well. So again, overall, I think the markets are moving down because of the fact, well, not because of the fact that the Federal Reserve, quote unquote, admitted that they were wrong. That is still not true, right? That is not a fact, okay? But because of the fact that the Federal Reserve is most likely being slightly cautious from this point forward into next fiscal year, that this current economic expansion, which will continue, well, hopefully, right, we always love to see the economy expanding, could potentially cause inflation to be sticky. Does everyone understand that? Okay, remember this, please, as we head into next year. It'll be very, very important. I'm giving you guys my complete, honest opinion and speculation as to the reasons why the Federal Reserve is being a little bit cautious now with more rate cuts next year. Hence the reasons why the markets reacted negatively to the potential of only 2 rate cuts, or what I like to say, 2 to 3 potential rate cuts in the next fiscal year. Does that make sense? Okay. I see your guys' reactions. Awesome, awesome. Alright, so with all of this in mind now, let's take a look at the technical analysis for the overall markets. Okay, so first of all, SPY has been moving straight down after yesterday's FOMC rate decision and the news conference. And all the markets have been looking pretty weak. Market breadth is finally horrible after showing, well, it's really, really horrible, even though it was getting to the levels of horribleness in the past 2 weeks. If you guys have been taking a look at the market breadth, or even just take a look at RSP, right, the equal weight ETF. So for me, the S&P 500 still has a little bit more room to move to the downside. All right, and if you take a look on the RSI for the daily time frame, we're getting to the oversold values very, very soon. Okay, we're at 37.45. We ended today at 37.45 as the closing price was at $586.10. Okay, now this is good and all, right? And the price is literally back to a previous all-time high level of $385. But if you go on the weekly time frame, so we have to go on the higher time frame. Okay, the RSI is still elevated here. And it closed at 57.12 today. Now, the reason why I'm saying it's elevated is that, well, for the past couple of months, okay, or actually even for for most of 2024, I would say, the RSI on the weekly time frame has been sitting between 60 and 70 or even higher, right? So whenever we're sitting around the median of 70, okay, so between 60 and 80, so the 70 value here, it's a little bit we just need to be a bit cautious, right? But during a bull market, that simply means that there's a lot of bullish momentum, and we're still seeing some very good strong uptrends with the occasional low dip, right? A very, very tame dip to the downside. Okay. However, oops, let's continue to have the music here. However, right now, okay, it seems like we're trying to correct back down to the more average levels on the RSI for the weekly time frame. If you guys are wondering what the average levels are for a good RSI, quote unquote good, and it's a bit subjective here, okay, what I mean by that is I want to see the S&P 500 coming back down to a more optimal range on the RSI on the weekly time frame around 40 to 50. All right, and so that means that there's a lot more downside left for the overall markets. Okay, so with all of that in mind, okay, so with this RSI in mind, let's take a look at the price levels. Okay, so again, what am I trying to say here, guys? I'm trying to say that the markets have a bit more of room to the downside because the RSI from a subjective, okay, it's not objective, subjective standpoint, from my own personal subjective standpoint, that it has to come back down to more optimal levels on the weekly RSI of around 40 to 50. Now the price here actually confirms that, right? Obviously the RSI is a lagging technical indicator. Okay, so obviously we're not going to go by just the RSI. We'll be looking at the actual data itself, the price action and the candlesticks here, and the candlesticks on the weekly time frame. I mean, this week looks absolutely ugly, right? We've broken below the weekly 10 SMA, which we've been riding very, very well ever since August's low, right? And the fact that we've broken it now and will most likely be staying underneath it by the close tomorrow, even, you know, it doesn't matter if it bounced to like 590, 588, 589 tomorrow, we're still going to be underneath this weekly 10 SMA, this red line. So usually, based on how my SMAs move and their behavior, whenever we decide to break below a major SMA like the 10 SMA, the price decides to continue to come back down and retest the next major SMA, which is my 21 weekly SMA, this light blue line. All right. So obviously this, I'm being short-term bearish right now for the trend. Okay, and also if we move back down to retest with the weekly 21 SMA, that will completely reset the RSI back to quote unquote subjective optimal levels or range between 40 to 50. Does that make sense, guys? Wow, we have 113 people in here. Awesome. So if anyone who's just joining in now, you guys have missed the bulk of the stream so far. So make sure you guys watch the stream replay, right? Once the stream is done. But for anyone who is just joining in now, make sure you guys hit that like button down below. And if you guys are new here, make sure you guys hit that subscribe button if the stream is helpful and most importantly applicable for tomorrow or for the next couple of weeks or even into the end of this year. All right. Okay. So as I was saying here, all right, from a technical perspective, we still have more room to the downside based on the price action, just on this weekly candlestick alone, right? And obviously this breakage below my weekly 10 SMA, which will automatically set a rule for the price to come back down to retest with the weekly 21 SMA, which is currently continuously rising up higher to catch up with the price. So what does this mean, right? What does this mean? Well, personally for me, I really want the price to come back down to I'll give you guys a range actually. 579 to 578. How about that? All right. So 578.5 550-ish was the previous all-time high support level that we saw back in for most of October and early November. But if we do come back down here, I really want to see some very good buys coming in, some good line in the sand moments once we do come back down here, whatever week that we might come down here in, and potentially see the weekly 21 SMA coinciding with that area or that range between 578 to 579. Does that make sense, guys? And so for anyone who wants to play puts on SPY, well, you guys have your set your set levels here, okay, and your set price targets for any type of put position that you guys want to have on the overall S&P 500. Now, when it comes to buying the dip, okay, this is where I think we can potentially buy the dip. If you guys want to start dollar cost averaging already on S&P 500, if you guys had gotten into the markets late, so like maybe at the dip in October, right? I'm sure there were people who bought in around the dip of October or early November. You guys can also see it this way as well. Whatever it was or whenever it was, and if you guys want to start dollar cost averaging, once we do see, again, we have to see a confirmation of the price hitting 578 to 579 and having a nice pivot. And if you guys want to dollar cost average there, fine, go ahead. But right now, tomorrow, you do not want to buy the dip in the market, right? Because right now, the overall sectors are still very, very weak. The market breadth continued to deteriorate as we head into the close of today. Now, here is what I've told my CFO Sringer Watch report readers and members of the private CFO Discord. Okay, so I gave everyone this kind of rundown yesterday, right? So let me give you guys a quick peek, a sneak peek at what I've said here. Okay, all right, so this is the analysis that I gave everyone last night. Okay, so let's actually read this together. All right, so I said I gave everyone a daily time frame of SPY, and I said that this candle today was most definitely and obviously an overreaction, but the price action to the downside clearly showed bearishness that we do not want to see during an uptrend. This move lower is definitely showing some topping signs. Now, as far as the daily SMAs go, the daily 50 SMA, which is my dark blue line right here, okay, has been broken. But since today was an overreaction, I expect a quick intraday oversold bounce back to retest it and maybe even close back over it tomorrow and into the end of the week. That means that we need to get back over to 591 to 592 to see that happen. Now, let me do a quick review of that analysis, because today, guess where we went up to, right? So today at open, we were at 591.36. So we had literally an overnight bounce back towards the daily 50 SMA, and we ended up moving up higher over 591 on the opening price, and at 593, so just $1 away from my 591 to 592 maximum range, okay, or 592 maximum range, we saw an immediate rejection back down, okay? And so that's kind of my review there for my analysis, okay? Now let's continue. Also, notice how we could possibly range trade between 585, the previous all-time high resistance level that I mentioned many times, and the psychological whole number level of 600. It's a large range, or a huge range, but with VIX elevated, the swing ranges per trading day can allow this range trading to occur. In fact, we did this post-elections from November through 15th with fairly low market vol, so no reason to not think that this can happen with elevated market vol this time around, right? So the reason why I said this is that, well, if we do decide to consolidate around the daily 50 SMA, we can range trade between 585 to 600, and the market vol, or the VIX, okay, the volatility index of the S&P 500 is still above the value of 20, which usually indicates that a correction is near. So with this market vol elevated, which means obviously again that there's going to be very wide price ranges in the overall market, well, every single market trading day, like we saw even today, there's a possibility that we can be seeing wild ranges from 585 to that psychological whole number level of $600. Alright, so you guys can expect that before I'm back down to reset my RSI on the weekly time frame, or if you do see a pivot or retest of this 578 to 579 range or area. Does this make sense, guys? Okay, now let's go over one more thing here and give you guys another sneak peek of what I told my members. Okay, now, okay, so what's the game plan here? Now, this is something that you guys might want to screenshot or remember or watch on the replay. As I've stated above, the first thing to do is not have trigger fingers. Stay patient. Second, we should be pivoting our mindset to shorts and less longs. Of course, one day does not make a trend even for a day like this, but the overall markets have been moving lower for nearly 2.5 weeks. And I said again, take a look at RSP and focus on what I've been saying about this ticker since last week in the report. And so any large bounce means that we have more opportunities to grab hedges at cheaper prices compared to today, which is again yesterday, since I've sent this message last night, against any long-term positions we have on any other individual tickers, or we basically can have put/short positions on the market if you don't have any other long positions. Now, there's more down here, okay, there's more down here, but that becomes a bit more specific and more orientated towards my private members and CFO Swing Watch Report readers. So, if you guys want to know the rest of the game plan that I've written for my members and readers, make sure you guys become a reader tonight. And again, how can you become a reader and a member tonight? Well, first of all, just to avoid any confusion, when you do become a CFO Swing Watch reader, you're automatically become a you're automatically classified as a private member of the private CFO Discord, and you'll get full access to the entire Discord. And for anyone who is just watching now and who is a part of the report and the private CFO Discord, you guys can go ahead and give you guys a quick review in the live chat for any of the people who are not members, and give you guys his own, you know, short thoughts, right? And again, I always let my readers and members speak for themselves. And again, the reason why I'm so confident in the fact that you guys will not regret joining is that, well, I've just read the reviews from my current readers and members. That's it, all right? That's the reason why I'm so confident, okay? So again, this report and the overall trading community that we have here at Charts Focus 1 will allow you to have a learn and earn system as you continue to learn a lot. You guys will most definitely 100% or even 1,000% guaranteed you guys will learn a lot, and at the same time simultaneously you guys will be able to earn based on that knowledge that you have learned. Does that make sense? Okay, so again, you guys can take a look at the link down below in the description box, and it will be the link that is obviously next to the words that say CFO Swing Watch. Okay, I mean I don't think I have to explain this, you know. I'll just skip on that. You guys can see it down below, right? I mean it literally says the CFO Swing Watch report and gain access to the CFO Discord community. Okay. Does that make sense, guys? Okay, so with that in mind, okay, if you guys want to, oh, hey, do nothing, you said best thing to happen for me was becoming a member. Yes, there we go, thank you. So there's one of our members there, right? So again, guys, if you guys want to see the rest of the game plan that I have for my team here, make sure you guys become a CFO Swing Watch report, which will also automatically classify you guys as a private CFO Discord member. All you have to do is check out the link down below and choose one of the subscription plans, and you guys are set to go. All right, now one more thing, if you guys want to know how to get a 50% off discount code for your first 30 days. You simply just have to DM me on Instagram at chartfocus1. Alright? Okay, so just to finish things off here, I know this is a long stream, but again, thank you guys so much for joining and even just staying with me for a while. Make sure you guys understand that for now, again, don't have those trigger fingers just yet. Allow the markets to digest this entire, excuse me guys, this entire move down and this overreaction full of emotions, and let the news and dust settle, right? And as that happens, I would love to see some more consolidation around this daily 50 SMA and possibly even range trade between 585 to 600. Does that make sense, guys? And again, this could be possible because the overall volatility index or the overall market vol is very much elevated and staying over that critical value of 20. And along with that, okay, on top of that, on the weekly time frame, we still have more room to the downside because the price has broken below this weekly 10 SMA. And when that happens, and once that does occur, and once we do close below the weekly 10 SMA, the rule is set for the price to move back down and retest with the next major short-term SMA on the weekly time frame, which is my weekly 21 SMA. And once that does occur, the RSI on the weekly time frame should come back to the more optimal levels or ranges, the value ranges for the RSI around 40 to 50. Because this entire year, the RSI has been staying around 60 to 80. All right, or between the ranges of 60 to 80. Does that make sense, guys? And again, that wasn't a bad thing, right? During a bull market, we want to see these elevated values in the RSI because that just clearly tells you that the overall trend, higher time frame trend, or the bigger picture is still to the upside. But we're now starting to lose that structure here of staying between 60 and 80. And so if this move down continues to go further below, and if we continue to see more sell-off next week, which is a short holiday week, we will see the RSI coming back to that more optimal levels, the overall average historical levels of 40 to 50 on the weekly time frame. And once that does happen, the price should be around the 578 to 579 range that I gave you guys a couple minutes earlier. Does that make sense? Okay, and again, that should also coincide with my weekly 21 SMA. Okay, and I see you guys' reactions there. Awesome, awesome, awesome. Okay, so that is what I think about quote-unquote buying the dip in the markets. All right, so hopefully this video or this stream, whenever you guys are watching it, the replay as a video or the current stream right now, was very useful and most importantly applicable for tomorrow and for next week or even into the next year, right? And if you guys want to gain more access to the knowledge that I have, the plethora of knowledge that I give every single week, okay, on a weekly basis through my CFO Swing and Watch report. Again, you guys can join by clicking the link down below that literally tells you guys where to go. Just look at the description box down below and you guys will see it. Now, if you guys want to take up the opportunity of joining us using a 50% off discount code for your first 30 days, make sure you guys DM me on Instagram at chartsfocus1. Again, you guys could pass on the opportunity and just click on the link down below that is shown in the description box. Okay, again, it's in the description box down below. Just look for it, it's there. And if you guys want to just join right away using one of our subscription plans, go ahead. I have no qualms with that, but I'm just letting you guys know that we do have a 50% off discount code for your first 30 days, which I do think 100%, 1000% you won't regret doing that. Okay. Alright, so that is it for tonight's stream. Hopefully that was very, very useful. Again, buying the dip, probably not right now, but the time will come as we will see we will have to see actually how the price reacts at my weekly 21 SMA and around this 578 to 579 range or demand area, and how my weekly RSI looks and hopefully it will be around that 40 to 50 optimal range. All right. Okay, so thank you guys so much for the huge amount of support that I've been getting. This channel is currently just growing in a crazy rate, at a very, very crazy rate. I mean, we were at 460 subs just yesterday, I think, and we popped up to 475 tonight. I mean, that's a lot of people that joined, right? That's a lot of people. So again, let's keep this ball rolling. Let's continue to expand exponentially. It's awesome to see this community growing, the CFO community. And again, I really hope that you guys are always finding these Tuesday and Thursday streams to be very, very useful, and most importantly, always applicable for your own trading journeys. And again, you guys can apply even more and learn even more through the CFO Swinger Watch report and through my private CFO Discord community. With that, I'll see you guys next week on Tuesday. Okay, and again, Tuesday is Christmas Eve, so remember that. On Tuesday at the same time at 8:30 p.m. Pacific Standard Time or 11:30 p.m. Eastern Standard Time. And for anyone who's new here, our stream schedules have always been the same: Tuesdays and Thursdays at the same time at 8:30 p.m. Pacific Standard Time or 11:30 p.m. Eastern Standard Time. Thank you guys so much for joining, for supporting, for liking, for subscribing. Thank you so much for staying with me. Have a great rest of your night. Now see you guys next week.